This is Ejaz Khan. Today we will be solving ACCA past exam question of F9 Financial Management. The name of the question is the Duo Company. This question was examined in December 2000 exam session. The question is regarding investment appraisal of the F9 syllabus. Well, let's look at the question. The Duo Company needs to increase production capacity to meet increasing demand for an existing product, Quago, which is used in food processing. A new machine with a useful life of 4 years and a maximum output of 6 lakh kilograms of Quago per year could be bought for 800,000 payable immediately. The scrap value of the machine after 4 years would be $30,000. Forecast demand and production of Quago over the next 4 years is as follows. Demand for year 1, 1.4 million, 1.5 million for year 2, 1.6 million for year 3, and 1.7 million for year 4. Existing production capacity for Quago is limited to 1 million kilograms per year, and the new machine would only be used for demand additional to this. The current selling price of Quago is $8 per kilogram, and the variable cost of materials is $5 per kilogram. Other variable costs of production are $1.9 per kilogram. Fixed cost of production associated with the new machine would be $240,000 in the first year of production, increasing by $20,000 per year in each subsequent year of operation. Duo Company pays tax 1 year in arrears at an annual rate of 30% and can claim capital allowances on a 25% reducing balance basis. A balancing allowance is claimed in the final year of operation. Duo Company uses its after-tax weighted average cost of capital when appraising investment appraisal projects. It has a cost of equity of 11% and cost before tax cost of debt of 8.6%. The long-term finance of the company on a market value basis consists of 80% and 20% debt. Well, the requirement of the question is to calculate the net present value of this project. So we are going to calculate the net present value of this project. There are a few things that we need to keep in our minds before we can solve the question. Number one, the total demand in the question has been given, whereas we will only consider the additional demand that we will be able to capture because of purchasing this new machinery. The existing capacity is 1 million kilograms per year, whereas the maximum demand for the product is 1.4 million. So remember, out of 1.4 million, we can capture 1 million kilograms with existing capacity. So the 1 million demand has nothing to do with this new machinery. So this machine will only be used for the additional 0.4 million or 400,000 kilograms. For first year, 0.5 million kilograms for second year, 0.6 million kilograms for third year. In the fourth year, the maximum demand is 1.7 million and the additional demand is 0.7 million. But since we've been told that the maximum output of the machine is limited to 600 kilograms, so we can only capture 600 kilograms of the additional 700 kilograms. So for the fourth year, we have to restrict ourselves to 600,000 kilograms only. Let's start the question. Let's first calculate the tax benefits on capital slash balancing allowance. In the first year, the cost of asset will be 800,000. So in the first year, we will be allowed 25% of the cost as a tax depreciation. 25% of 800,000 is 200,000. So for the first year, our taxable profit will be reduced by 200,000, which means that we don't need to pay tax on 200,000. So it will make us save 30% of 200,000 in the first year. So the tax benefit arising from the purchase of this machinery for the first year will be $60,000. But since it has been told in the question that we have to pay tax in 1 year in arrears, this tax saving belongs to year 1, and due to arrears it will be paid in year 2. Pardon, it will be received in year 2. That this tax benefit will be received in year 2. For the second year, the cost or WDV, so definitely it will be the WDV for the second year. It will be 600,000, that is 800,000 minus 200,000. So for the second year, the WDV is 600,000, and we'll get 25% of the 600,000 as our tax depreciation, which will be equal to $150,000. And the tax benefit on $150,000 will be 30%, that is $45,000, and it will be received in year 3. For the third year, the WDV will be further reduced to $450,000, as a further 150,000 of depreciation will be deducted from the WDV of the second year. So the amount will be 450,000. 25% of this 450,000 will be allowed as tax depreciation. We'll get tax benefit of 30% on 112500, which will be equal to 33750, and this amount will be received in year 4 because of arrears. So by the end of year 3, we'll be having a WDV equal to 337,500, that is 450,000 minus 112,500. So this is the WDV by the end of year 3. By the end of year 4, we will be able to sell this machine for $30,000. So the unclaimed cost of the asset will be further reduced by $30,000, since we will be able to cover this amount by selling the machinery. By subtracting 30,000 from the figure 337,500, we get $307,500. This is the amount which is actually the unclaimed cost of the asset. The tax, since we don't have any further year to claim any capital allowance, therefore the whole of this amount, that is 100%, will be allowed as tax depreciation called balancing allowance. So the whole amount will be tax depreciation, and we will receive 30% of this tax depreciation as our tax benefit, which is $92,250, and it will be claimed in year 5. So these are our tax benefit figures which we will put in our NPV calculation. The second working will be the total contribution per year. According to the question, the price of the product will be $8, variable production cost will be 5, and other variable costs will be 1.9. So if we sum these two, we'll get the total variable cost, and we'll be subtracting it from the selling price to get the contribution per unit figure. This contribution per unit will stay same for all the 4 years according to the question. The only difference will be the sales volume for every year, which we have already discussed. So the additional sales volume for every year will be 400,000, 500,000, 600,000, and 600,000. So if we multiply the per unit contribution with these sales volumes, we'll get total contribution figures for all of the 4 years. So these are the contribution figures for all the years. Then we have another calculation for weighted average cost of capital. Let's go back to the question and see how we can calculate it. The cost of equity is 11%, whereas the weightage of the equity is 80%. So all we have to do is to take this 11% and take 80% of this 11 and add 8.6% is the cost of debt, but which is before tax. So we have to make it after tax. So if we take 8, if we take 70% of 8.6, it gives us 6.02, which can be taken as 6%. So just taking 70% of this cost of debt to make it after tax, because the tax rate is 30%, so we have to deduct 30% from the cost of debt to make it after tax cost of debt. So it will be equal to 6.02%. So we can take it as 6 and we can multiply it with the weightage of the cost of the debt. So we take 80% of 11 and 20% of 6 and add them together to get the weighted average cost of capital. It's approximately 10%. So we'll use this cost of capital as our discount rate. Now let's go to the calculation of net present value. We've already calculated contribution for every year. We've just put it in the right column. We were being told that the fixed cost for the first year will be $240,000, which will start increasing by $20,000 every year. So we are just adding $20,000 to these $240,000 every year. For the first year, the contribution was 440,000. We subtracted fixed cost from it, and we got taxable cash flows for every year. Then we had 30% tax, which we were supposed to pay in arrears. So if we take 30% of 200,000, it will be equal to 60, but we won't show it in year 1 because of arrears. So we'll show it in year 2. Then we take 30%, which will be equal to 87. If we take 30% of 380, it will be equal to 114, and if we take 30% of 360, it will be equal to 108. Since we have to pay tax, therefore these figures will be shown as outflows. We had tax benefits for every year, which were equal to 60,000, 45,000, 34,000, and 92,000. Let's check these values. We have already calculated 60,000, 45,000, 34,000, and 92,000. So these are figures. Then we will be selling the asset by the end of the project, which is 4 years, for $30,000. Now let us net off all these figures to get the net cash flows. So we have these net cash flows. Then we had calculated the cost of capital as 10%. So we'll be taking the discount factors for 10% to get the present values for each year. So we just multiply it with the discount factors to get the present values for the cash inflows. And if we sum all these cash inflows together, we'll get 878,000. Since the initial investment for this project was 800,000, we'll save $78,000 in present value terms. Since the net present value is positive, the project should be undertaken on financial grounds. I hope you have understood the question. Thank you for watching the video. Bye bye.